As a Tesla stock investor, I am seriously surprised by this news. Check it out.
Raising his price target on Tesla to $350. So you actually raise, even though the stock is down and the market's worried about more price cuts.
The reason why this is seriously surprising is because Dan Ives usually goes with the sentiment. Whatever the sentiment is, that's where his price target goes. This is a complete opposite of that. As I'm recording, Tesla's stock is down 9% today, but his price target increased from $300 to $350. I know it's popular to make fun of Dan Ives, but he is now in the top 50 almost of all of Wall Street analysts. And while his methods can certainly be questioned, he has been right about Tesla stock according to TipRank 74% of the time, which is actually pretty high if you trade Tesla stock. One more reason why Tesla stock is lower today is because Tesla is recalling about 16,000 Model S's and X's. The front row seatbelts may not be connected properly to the pretensioner anchors, which can cause the seatbelts to detach. So it seems like a pretty simple and cheap fix. I'm not worried about that.
I think investors aren't seeing forest through the trees, because ultimately what's happening here, we're seeing a stabilization from a margin perspective, better than expected in terms of auto gross margins. You look at units, right now I think on a trajectory toward 2 million, and then this is the drum roll, the Super Bowl, to now what I believe is monetization of supercharger, battery, and I think last night the biggest thing from the conference call, FSD talking to another OEM, because this from an AI perspective is ultimately how I see Tesla getting to $1.5 trillion, $2 trillion market
licensing
cap.
FSD to another OEM. I mean, he said early days, it's never clear. We got no clarity on who it is or how far along or whether it may even come to fruition.
Even though Dan's price target is only $350 for Tesla stock, he does see Tesla reaching a market cap of $2 trillion, which would more than double Tesla stock from where it is right now. And recently, Dan's track record has been great on Wall Street, so if he is right, that is great news for us Tesla stock investors.
For Musk, I think ultimately this is really the first step of what's going to be a broader strategy, because they've built it. I mean, if you look at FSD,
Full self-driving,
and I'll argue, Sarah, that's AI. I mean, we could talk. It's basically AI for automakers. You look at full self-driving, you look what happened with superchargers, and ultimately now batteries. And I think the story's stabilizing from a margin perspective. The poker move massively played off from a unit perspective. And I think that's why this year, I think this is just the start.
The poker move being lowering prices.
Because if you look at the lower prices, sacrificing prices for demand, it paid off, not just in China, in the US. And I think what you're seeing right now with EV play out, you're starting to see this green tidal wave we viewed as the biggest transformation to the auto industry since 1950s. It's Tesla's world, everyone else is paying rent. And I think last night was just another chess move while other automakers sit there playing checkers.
Here's something to seriously think about. If Tesla sold ADAS and autopilot, so not full self-driving, for merely $1,000 in profit to a company like Ford for all their vehicles, Tesla's net income would increase 30% from 2022 instantly, says Meet Kevin. Just recently, everyone was so excited that other automakers are now able to access Tesla's superchargers, and Tesla stock went crazy. But I think the real catalyst would be if all of these automakers started to license Tesla's technology, for example, autopilot and full self-driving. That, I think, would really rally Tesla's stock.
What about the factory potential delay of shipments? That was something that was flagged on the call.
Yeah, and
is that a big deal?
Yeah, and that's one where, and to your point, a bit of a downtick, production offline from a manufacturing perspective. See, I view that as really what's going to be the start of a refresh for Model 3s. So I think that's a smart move, because you're going to have refresh of Model 3s, you got Model Ys, and then ultimately the Cybertruck, we think production starts around Halloween. I think we will start to see Cybertrucks on the road in the month of December.
You do. And do you think people are actually going to buy them?
I think right now, if I look just where price points are and just what demand looks like from pre-orders, this could be something where ultimately it's $200,000-300K per year as it starts to ramp in terms of Cybertruck. And that's why Austin, if you look at what Tesla's done, Austin, Berlin, of course, China, what we see now more and more, what will be coming out of India and others, they got the scale and scope where no one else has. And I think that's what's starting to play out here. I view Tesla, it's Apple 2008, 2009 in terms of the story playing out.
When you hear one of the top Wall Street analysts say this is like Apple in 2009, I think you would be wise to at least listen, unless you want to miss out on potentially a lot more than a 10x.
You've been right, by the way. I want to make that clear, and that's the most important thing. But people say you're just a perma bull. Is there anything that this company could do that would change your opinion?
Yeah, and to that point, like if we start to see like massive demand issues in China, more price cuts where margins get cut and you start to get to 13, 14, 15% margins, then that changes the thesis. But David, to my view here is that we are in the second inning of just a massive transformation in this fourth industrial revolution, not just in terms of electric vehicles, but I believe also when it comes to Tesla, it's the AI story. I think the sum of the parts story, I view this as an AWS moment, similar to what we saw with Amazon, AWS.
You said it.
That's starting to happen now. Supercharger, battery.
And now licensing full self-driving technology to other automakers. Yesterday, someone in the comments called me a permabull, which means that I'm always bullish about Tesla stock, but that person must have not seen this video in which I said most likely actually it will drop further, meaning Tesla stock. This was when Tesla stock was at $300 per share last year. And indeed, the stock dropped and I kept buying. But are we going back to $100 per share? Well, while it would be nice for me to buy more Tesla stock at $100 per share, I don't think it's likely. Although if we do have a terrible recession where everything drops and Elon Musk at the same time sells Tesla stock, I wouldn't be too surprised if we do reach those levels again for some period of time.
Do you think that we've seen the lows for gross margin X credits from Tesla?
Yeah, I think as Tesla said, I would expect credits to be, they already are a smaller picture than what they once were, and that's going to dwindle over time. We've modeled Tesla's future gross margins based on Wright's law. We know that they are decreasing cost per vehicle, which is very important. Of course, I actually think the Cybertruck is going to help with that, and we know that the first vehicle was produced, or is coming out. So I think longer term, we actually think gross margins could be about 50% if you look at the 5-year forecast. So that's not just driven by electric vehicles, by the way. It's driven by AI, which you all touched on. So we think Tesla's going to be a leader in autonomy. We think they could take a very attractive take rate off of gross revenues, off of an autonomous ride-hail service. And that's really going to be the story today. I think not enough people are talking about Tesla is, it's one of the most important AI stocks to be talking about at this very moment.
Yesterday on the earnings call, Elon said to look at ARK Invest research about Tesla, and even though ARK Invest numbers can sound a bit crazy at times, Elon Musk seems to think they are not that crazy. 50% gross margins would certainly be nice, and remember, ARK Invest has been generally right or certainly less wrong about Tesla stock in the long term than all of these other analysts. I think there was one point that was not well understood yesterday on the earnings call because it was a bit technical. Drew confirmed the Gen 2 4680 cell is 10% higher energy density and it's now meeting their expectations for energy density compared to similar chemistries. That is, the 4680 is now comparable to a 2170. That's not to mention the structural pack benefits.
I think auto margins will also improve as, again, vehicle costs decline. We've modeled, Wright's law says that for every cumulative doubling in production, you get a corresponding reduction in price. If you look back over the past 100 years, this models what the auto industry has done extremely well. We think it'll be the same thing with electric vehicles with Tesla.
The Wright's law states that a 15% cost decline with every cumulative doubling of units produced is experienced in the automotive industry. But it is also important to understand that you can't apply that to every single part of a vehicle that is an EV. For example, tires. We haven't really had some significant innovation in how we produce tires, but we certainly are still experiencing huge cost reductions in batteries in the long term and the EV powertrain and all of the new things that go into EVs that we don't have in gas-powered vehicles. So if you use the Wright's law, just remember, if you want to pinpoint exactly where all of the cost savings are going to come from, remember that it is applicable only to the cumulative doubling of all of the production. So for example, if you look at tires, we would need to go back many decades. And then we find out exactly how many tires we have produced until today, and then we would need to double that amount to experience a significant cost reduction. But for such components like batteries and all the new things that go into EVs, yeah, we are experiencing cumulative doublings very quickly, but for something like tires, that's going to take a while.
I do think that autonomy longer term is going to be driving Tesla's margins. I think it's the most important thing that they are focused on and that they should be focused on. And hey, they're in a great position. I mean, if you look at what they reported, miles in full self-driving are over 300 million cumulative to date. Compare that with competitors like Tesla and Waymo that have autonomous projects. That's in the low millions. And Tesla's averaging over 2 million miles per day at this point in full self-driving, even more when you look at the total fleet, what's not in full self-driving. So they have a data advantage that is unparalleled in this industry. And I think it would be extremely hard for anyone to catch up with them at this point.
People like to make fun of ARK Invest, but when you look at ARK Invest Tesla stock predictions from 5 years ago, ARK Invest really is the one that should be making fun of everyone. In 2018, ARK Invest said that Tesla stock would be $4,000 per share. That was a 5-year Tesla stock price target. 5 years now have passed, and when we adjust that for the 2 stock splits we had, that would be equal to almost exactly where we are right now, $265, and they were predicting $266. At that time, by the way, the highest price target among the Wall Street analysts who cover Tesla was just $500, compared to Cathie Wood's $4,000. This, of course, is a 12-month target, but Cathie Wood's price targets are 5 years. Split adjusted, that $500 today would be $33.
Tesla, after a strong start to the year, didn't raise its vehicle delivery guidance from 1.8 million. Is that the only thing weighing on the stock?
What we saw last night in results was emblematic of a company that's investing to create long-term durable growth. And they're doing that in multiple ways, right? So first, they cut prices, which you referred to earlier in the year, and that's seeding the market with units. And with those units over time, they hope to basically penetrate FSD software that will create margin upside over time. They're also spending a lot in OpEx. They're doing that to beef up their AI infrastructure, to enhance that FSD offering, maybe even sell. They alluded to this yesterday on yesterday's call. They're also investing in battery technology with 4680 cells. They're also investing in robotics, right? The Tesla bot could create long-term durable growth, for later on in the decade into the 2030s. So this is a company that, despite an erratic macroeconomic environment, is still putting the pedal to the metal and investing in projects that should create growth for the long term.
It appears to me that Tesla stock analysts are actually overall reacting positively to Tesla's earnings, unlike the stock market. Here's a price target increase from Truist Securities, and here's another price target increase from $300 to now $330, and we all remember Dan Ives increasing his Tesla stock price target to $350. Gary Black is also quite positive about Tesla's fundamentals. He says if Elon stops talking about autonomy until it works near flawlessly and focuses on his amazing existing businesses, EVs where Tesla dominates everyone, because there's no competition really, and energy where profits just tripled and gross margins are now higher than on EVs, Tesla stock would be higher, says Gary. Imagine if Tim Cook, the CEO of Apple, said that Apple is going to cut prices on iPhones and make it up on cloud storage and Apple Music and other services. That would never happen. Tesla stock fundamentals are outstanding, but that fact gets lost in all the noise. I think Gary does have a point here.
Do you believe this might be the bottom when it comes to its margin story?
Yes, so that's one of the issues in yesterday's call. The company wouldn't commit. They were very non-committal about seeing a bottoming in margins. We think we're there. So whether it's this quarter or next quarter, they broke this 20% pure gross margin guidance, and right now they're in about the 17% range, and I think that's probably why they don't want to commit to this being a bottom. But if you look forward into Q4, into 2024, we have the Cybertruck ramping, we have additional volumes helping growth, we have 4680 cells ramping, so We think that this particular level probably represents the bottoming process for gross margins.
And even if it doesn't turn out to be this way, remember, Tesla has not started advertising yet, and that, I think, would really bump up the margins by creating a lot more demand.
We think this is a relatively undervalued stock.
That basically sums up all of the reactions from most Tesla stock analysts today. And YouTube says you should watch this video next, but if you haven't finished watching the Tesla earnings call, do it now here. In that video, I actually listen to the earnings call and I take notes throughout it. Like and subscribe if you haven't yet, and I will see you in the next video. If you watched this video, just use the timestamps to go directly to the earnings call. Thank you so much for watching.